Hello everyone, and welcome back to the Canadian Real Estate and Mortgage channel. We are continuing our series on mortgages. If you have watched our last video, then you've probably decided which mortgage is best for you. This video will explore how that choice will impact your future. Well, for one, once you sign into a mortgage contract with the lender, you will enter into a term from anywhere between 5 months or more than 5 years. During this time, you cannot or are advised not to break the contract or sell your home, because the lender will then charge you a penalty fee if you do so. Therefore, you commit yourself to a specific term once you sign that contract. Moreover, you can also pay penalty fees if you pay your mortgage off early. Unless you plan on owning your home until you pay it in full, you may need flexibility in your mortgage. It is recommended that you plan for 15 to 20 years in the future when shopping around for a mortgage. It is best to look into the following options: opened or closed mortgages, portable mortgages, assumable mortgages, and any charges associated with it. Open mortgages. In an open mortgage, the interest rate is usually higher than a closed mortgage with a comparable term length. This allows you more flexibility if you plan on putting extra money towards your mortgage. This option may be a good choice for you if you plan to pay your mortgage off soon, if you plan to sell your home in the near future, or you think that you have extra money that you will put towards your mortgage from time to time. Closed mortgages. With closed mortgages, you have lower interest rates compared to open ones with comparable term length. Here, you are limited in the amount of extra money you can put towards your mortgage each year. Your lender calls this a prepayment privilege, and it is included in your mortgage contract. However, not all closed mortgages allow prepayment privileges. They will vary from lender to lender. A closed-term mortgage may be a good option for you if you plan to keep your home for the rest of your loan's term, or the prepayment privileges provide enough flexibility for the prepayments you expect to make. Portable mortgages. Choosing a portable mortgage gives you a lot of freedom, because if you were to sell your home and buy another, you would be allowed to transfer your existing mortgage. This will include the transfer of your mortgage balance, interest rate, and terms and conditions. This is the best option suited for those who have favorable terms on their existing mortgage, or if they want to avoid prepayment penalties for breaking the mortgage contract early. Assumable mortgages. An assumable mortgage allows you to take over or assume someone else's mortgage and their property. It also allows someone else to take over your mortgage and your property. The terms of the original mortgage must stay the same. You may want to consider an assumable mortgage if you're a buyer and interest rates have gone up since you first got your mortgage, or if you're a seller and want to move to a less expensive home but want to avoid prepayment fees because you have several years left on your existing term. Most fixed rate mortgages can be assumed. Variable rate mortgages and home equity lines of credit cannot be assumed. The lender must approve the buyer who wants to assume the mortgage. If approved, the buyer takes over the remaining mortgage payments to the lender. The buyer is also responsible for the terms and conditions set out in the mortgage contract. In some provinces, the seller may remain personally liable for the assumable mortgage after the sale of the property. If the buyer doesn't make the mortgage payments, the lender may ask the seller to make the payments. Some lenders may release the seller from responsibility if they approve the buyer for the mortgage. Check with your lender to see if your mortgage is assumable. Lenders may charge you a fee to assume a mortgage. Your mortgage contract indicates if you need to pay a fee to complete the transfer. Let's talk about charges associated with your mortgage. When you take out a mortgage, the lender registers a charge on your property. The type of charge determines the loans your lender allows you to secure against your property. A standard charge only secures the mortgage. It does not secure any other loans you may have with your lender, such as a line of credit. The charge is registered for the actual amount of your mortgage. A collateral charge. With a collateral charge mortgage, you can secure multiple loans with your lender. This includes a mortgage and a line of credit. The charge can be registered for an amount that is higher than your actual mortgage. This allows you to borrow additional funds on top of your mortgage in the future. To avoid paying fees to discharge your mortgage and register for a new one, you only have to make payments including interest on the money you actually borrow. These are but a few ways in how signing a mortgage contract can impact your future. If you enjoyed this video, be sure to give it a like, subscribe to the channel, and share with anyone who might find this information useful. That's all for now.